Good morning, ladies and gentlemen, and welcome to our first results presentation. I'm Raffaella Luglini, Head of IR and SRI. For the presentation today, I'm pleased to introduce you to our new CEO and General Manager, Mauro Moretti. He will begin with an overview, followed by an outline of priorities going forward. Then our CFO, Giampiero Cutillo, will take you through the first half results and outlook. Mr. Moretti will then give a brief wrap-up, and we will then welcome your questions. I will now hand over to our CEO.
Thank you, Raffaella. Good morning, ladies and gentlemen. It's my pleasure to meet you for the first time in this new job as CEO of Finmeccanica. And I look forward to getting to know you better over the coming months. We are here today to present to you our first half result for 2014. Let me start with the highlights. The group had strong order intake. This is very, very important for us. And important too is that book-to-bill ratio is about 1, a position it's kept since 2013. The group operating performance was broadly in line with the plan, with only one exception of a specific contract issue in DRS, our US subsidiary. Although we expect to recover this shortfall at group level by the year end. And we achieved positive cash flow generation in the second quarter, despite the enforced payment out of guarantees under the Indian contract that you know perfectly. Giampiero Cutillo, our CFO, will later cover the first half result in more detail. And he will so show you that we are confirming our full year 2014 guidance for orders, for revenues, and for EBITDA. Although the free operating cash flow and the net debt guidance will now be revised to factor what I mentioned before, the Indian case. You have to change the slide, please. You know, I have been in my new role for less than 3 months, more or less 75 days. And you will understand if I say less at this stage regarding our future journey until later in the year. I do want to give you briefly some key points on how I see the group and its challenges, and show you where our efforts are being directed and focused, some very clear priorities. So you can understand what I mean by a positive mix of continuity and discontinuity. I am very clear that it's a company that needs to move more aggressively to deliver sustainable profitability and cash to its shareholders. It's absolutely our need to have the confidence of our shareholders. It is my challenge to deliver that. And I accepted this role because I don't usually accept challenges that I am not able to manage. My experience in my previous role as CEO of the Italian Railways, and you know that the railways business is very tough, in Great Britain particularly, showed me that business that may appear to be challenged can be revitalized and repositioned. And also you must be prepared to take tough decisions to focus your effort and achieve your targets. And we can achieve our objectives at Finmeccanica if we commit to what I have described as positive mix of continuity and discontinuity. Positive continuity means making the most of the strength of Finmeccanica. Positive discontinuity means being decisive with radical changes where and when they need to be made, without any hesitation. So, first, let us look at what is apparent from the recent record for the group over the last few years. You can see that there has been a resilient commercial performance. Finmeccanica is a diverse group with some robust businesses delivering high-quality products and technologies to its customers. Our helicopters is world-class. Our training business is state-of-the-art and very well positioned to capture share in a growing market. Israel, Poland, Singapore, and so on. And having already met and spoken to many of our largest commercial industrial partners, I have seen that our business is underpinned by some world-class technologies and capabilities. Look at the track record in orders and revenues over the 4 years in tough market conditions. This is reflected in a book-to-bill ratio has exceeded 1 times every year apart from 1. And as per our guidance, we aim this year to maintain it at this level. More can be done. Finmeccanica is also a company that has gone through some challenging moments. And clearly, a lot more has to be done to improve our low profitability. A declining revenue environment and the number of specific operating challenges is reflected in declining EBITDA. Against this backdrop, a lot has been done to improve our margins in the last 2 years. And if we deliver our guidance, there will be further improvement for 2014. But we must raise profitability to a more satisfactory level. I know perfectly that we are more or less at the lower position compared to our peers. And that means reducing the cost base, especially SG&A costs. We have also had underperforming businesses that have been a drag on group profitability and cash. The most obvious example has been transport, and more specifically the rolling stocks and the buses, both. But our defense electronic business are also operating in some very difficult markets. And there are specific products and programs around the rest of the group that are a drag on performance. There have also been a number of one-off issues that, whilst isolated, impact result and erode confidence in delivery. You know the historical issues, so I won't go over them all again. And a lot of more has to be done to reduce the volatility of our net results. We need to reduce the volatility in the result we achieve from our existing operations with a more stable earning profile. And that also means we need to achieve a higher quality of earnings with less dependence on extraordinary gains and fewer impacts for extraordinary losses. We need to work to increase the group's cash generation. In recent years, this has been very weak. the transport business has been a consistent drag on cash. But we have also had unexpected issues that have undermined our progress. In the first half of this year, before the unexpected cash outflow on India, we were on track to achieve improved cash flow. And finally, we need to reduce our level of indebtedness in order to strengthen our strategic and financial flexibility. So, what do we need to address now? You know, defense budgets are under pressure, and civil business, the competitors are very tough. And having spent deep in the business the last 2 months and a half, I would share the following central priorities. You cannot respond effectively in this environment with a too diversified portfolio. It's incredible. When I faced for the first time our portfolio, I was astonished. Finmeccanica is involved in too many sectors, products, service, businesses, and investing in too many technologies. It's impossible to make this, to do this in the best way. We don't have enough resources to invest in all the businesses. A key driver for the future success of the group is how and where and when to invest. At the moment, it's not absolutely clear, the investment policy. So we must decide where to use our resources, not only financial resources, but particularly the human resources. High-skilled workforce are absolutely rare, and we have to invest those in the best way. Selecting and focus investment on fewer high-technology activities with positive and higher returns. And building an industrial plan that leverages the group's strengths and recognize its weaknesses. To focus successfully on a portfolio of profitable, cash generative, and strategically consistent businesses. With the key criteria here being long-term sustainability of profitability and cash flow, to make Finmeccanica a player able to compete successfully and profitably. For this purpose, we are carrying out a deep review and analysis of the entire product portfolio of every company of the group. Looking at the very single line of business, ranking them based on cost and opportunity toward investment, in order to decide whether to invest or to shut down or exit. We will share the result of this review as part of the new industrial plan later in the year, maybe December. We will share the result. I think that a key tool to achieve real change at Finmeccanica is the new divisional model, and we are going faster and further on corporate governance. I know that this discussion about the governance of the group is an historical issue. I would like to face the problem and resolve it immediately in a short period, medium short period. You know, within the 2015. Our recent announcement in June confirmed the changes already proposed, but goes further to enforce the implementation of a full divisional model for our core aerospace and defense businesses. The new model will reflect, first, what at the moment is core business for Finmeccanica. Aeronautic, helicopters, defense, and so on. And second, what is not core? Transportation, rail, buses, and so on. Construction industrial plan, FATA. And all what is absolutely incoherent with our missions. Third, we have sectors that have to undergo through a strategic evaluation. I think to DRS, the US subsidiary, I think at all the joint ventures. In practice, the new model will also provide for divisions to be equipped with all necessary function for an end-to-end business development and management. It will introduce technical structure to increase coordination and synergies across divisions, particularly in innovation of technology, R&D, and as well in investments. The model will centralize business support functions. International strength goals will be shared and governance integrated. We have a task force in place to lead the process. The execution of the new model will be completed to later than the end of 2015. And there are already quick wins that are delivering along the way. All the registered offices of the subsidiary is already come to the unique headquarters of Finmeccanica. And the CEO too. Yesterday, the board of directors of Finmeccanica decided to change the board of every subsidiary, maintaining the CEO, changing all the other directors, and having into the board of directors of every company some representative, the most important representative in Finmeccanica of the changeover, the central director of Finmeccanica, as chairman of the single subsidiary, to pull the change. We have also reduced the directors to only 3 people to have absolutely more efficient work of the board. Apart our identified priority, I want to show how we are moving aggressively on costs. Obviously, that the governance approach is already a new way to consider the cost of our company. We will accelerate significantly the cost-saving plan already ongoing. We will have a relentless and vigorous approach to optimize our cost base, first acting on the overheads and headcount, and in parallel on operating costs in order to improve industrial efficiency in both the most important process, engineering and manufacturing. Although I will say less now, but more later in the year, I want to give you a first simple but meaningful example about ICT. You don't have at the moment a unique ICT system in Finmeccanica. Obviously, that to control the company, we need of that. And we are going to implement this system. So we can not only reduce only cost and better efficiency, but we also can directly and effectively control all processes and businesses continuously. The continuous and virtuous search for cost optimization is not only about a managerial approach, but a key element in wider and deeper group cultural change. driven by values of simplicity and essentiality. Sorry. As a large and complex company, we have to be realistic. But we are not wasting a single day, and we are working actively on this priority to focus our effort over the coming month. To give another example of this, the Indian case, you know that we had a good resolution on the prosecutor in Italy about that. It's not a gift. It's not a sort of luck happening. It's a new approach that actively, proactively, go to the prosecutor, present the questions, and obtain solution. And the effect that we have tomorrow on the press, Indian press at least, that have to be confirmed, obviously, but the Indian press today present the new green light for the joint venture of Tata Group and Augusta Westland. It is immediately a result of what I would like to present you today. I have finished my first presentation. I give the floor to Giampiero for the detail, not only detail.
Thank you.
Thank you very much.
Thank you, and good morning. I will cover the group's financial results and performance in the first half of the year. I will also reiterate the full-year guidance we set out back in March. You will see a number of key points. First, the group commercial performance in the first half of the 2014 was really good. We have continued to achieve a strong order intake, and that's across almost all the operating businesses. Second, in the first half, the group's operating performance has been broadly on track and in line with our expectations, despite the issue with DRS contract. And we have also achieved a better than expected outcome in cash flow in the first half compared to last year, and that's despite the large payment resulting from the enforcement of guarantees on the Indian helicopter contract. The net debt at June was 4.8 billion euros, which is 400 million less than last year. With our lower below-the-line charges in the first half, I feel we are beginning to make a step towards our goal of a more normalized and less volatile earnings profile. After a good operational performance in the first half, we are confirming the full year 2014 guidance for orders, revenues, and EBITDA. We are adjusting the free operating cash flow and net debt guidance to reflect the outflow on the Indian contract. You can see on the slide the group's headline financial for the first half. Overall, what we saw is orders, as we comment, some really strong momentum with the new order over 7 billion euros in the first half compared to the 5 billion in the same period of last year. Revenue were flat as we expected at 6.5 million euros. EBITDA was lower at 351 million euros. This was slightly below our expectation, but we expect to recover this in the second half. As you know, the free operating cash flow for Finmeccanica tends to be seasonal and is always negative until the Q4. For the first half of this year, the free operating cash flow was negative at 1.1 billion euro, which is an improvement on last year, and that's despite the already mentioned 256 million euros of payment of the Indian contract. The group business performance was substantially in line with or better than our expectation in almost all sectors. With the exception for defense, electronic and security, where Selex improved, but DRS were adversely affected not only by the expected fall in volumes, but also by unforeseen technical issue in a specific air cargo handling contract. Looking at the aerospace and defense businesses, we say that there is a good momentum in order intake, with the new orders up 25% in the first half. This benefited in particular from a very positive performance of helicopters. Revenue were slightly softer and as expected, and EBITDA in the first half was lower, but only slightly below plan. Helicopter outperformed. Aeronautics and Selex performed well, but this was offset by the impact of losses on the DRS contract and from lower contribution from JVs. We do, however, expect to recover the lower EBITDA in the second half and to therefore meet our aerospace and defense and group profit targets for the full year 2014. You can see also on the transportation side a picture that has improved compared to last year. A notable increase in new orders, with the significant driverless metro order in Lima, Peru, and improved profitability in the first half in line with the action that we set out over the last 12 months. These have reduced the losses in vehicles segment, as we said we will do. Now let's look at the single operating businesses. Helicopter. This business again performed strongly and achieved good orders and strong profitability. There was a further excellent order intakes in the first half. In addition to the important contracts with the UK MOD already booked in Q1, other orders were won in Brazil and Australia during the second quarter. Helicopter revenues at 2 billion for the first half were flat, as expected, and we successfully recovered the temporary delays in some programs in Q1. Underlying profitability was very strong in the first half, with an EBITDA at 263 million euros and a return on sales around 13%, and actually much better year-on-year if we exclude the one-off benefit that we had in 2013 from the termination of the US presidential contract. And we feel positive about prospects for helicopters in the second half. Next, aeronautics. Here we saw a positive trend and improved profitability in the first half. The key points to note here is that it's evidence of progress on key programs, in particular on the B787, and it's evidence on the impact of efficiency measures and cost savings. We expect this positive trend to continue in the second half of the year. Order intakes was at 1 billion euros and was in line with the plan. It was lower year-on-year because of the very high comparator in the previous year. Aeronautics achieved a good first half revenue performance, with an increase of almost 10%, helped by the rise in production rate by the Dreamline program. This program is now a production rate of 10 shipsets per month, with all the quality requirements fully met. We have said before our commitment is to consolidate this level of quality at this higher rate. And the results achieved so far make us confident. Profitability was solid in the first half, and we also benefited from higher margin in the military segment. We have been encouraged by the progress here on the second wave of the cost reduction plan that we put in place this year. We have worked hard on the initiatives relating manufacturing, supply chain, and they are all proceeding well, although there is still much to do in the second half of the year. Moving to European Defence Electronics and Security, SELEX. The key point to highlight here is the strong commercial performance. You can see this in the order intakes, which is up almost 20% in the first half. And secondly, the improving profitability driven by the combined effect of restructuring benefits and the successful addressing of the last year issue on air traffic control. The order intakes at 1.4 billion included some important contract in airborne and space system segment. Most notable was the renewal of the avionics maintenance center contract for the Italian Air Force Typhoons and the supply of radars in the Swedish Air Force. First half revenue were level with 2013 as per plan. We expect profitability to improve further in the course of this year as we get more benefits from the restructuring initiatives. Moving to US side in electronics at DRS. Here order intake was in line with the plan and included an important new contract to supply the US Army with the ground and satellite telecommunication services. DRS revenue were lower, but was in line with the expectation, reflecting the US defense spending. However, we saw in DRS the one real disappointment in the group's first half performance. Losses were incurred relating to technical issue in a specific contract for the development and production of a cargo handling and transport system for aircraft. The position was assessed in May, and we have made all the provision which we think are adequate to cover all the losses of the contract. Had it not been for this contract loss, DRS would have been in line with the plan for its profitability. For the full year, we expect profitability to be low single digit. Space. Here, as you know, now only we consolidate our share of the net income for these JVs. The contribution fell in the first half, impacted by the cost of a restructuring plan launched early this year. In defense system, here there is a mix of 100% owned and consolidated business, as well as the MBDA missiles joint venture, where we see the net income contribution. As per plan, for this segment, order intakes and revenue were lower in the first half. Also, we expect profitability was lower, mainly due to the changing business mix in the missile company in MBDA, following the completion of important contracts. You have heard our CEO earlier talk about our determined and relentless approach going forward to cost cutting. We feel positive about the benefits this will bring, and it will add to the benefits we have been getting from action taken under our existing plan. So you should remember that our existing plan is aiming to get 300 million euro of cost saving by 2014 and 15. Anything more we get under the new approach will be incremental on top of this. Let's talk about the liquidity. As you know, our cash flow is seasonal and heavily weighted to the second half of the year. The group free operating cash flow in the first half was negative, as you see, at 1.1 billion euro. This outcome was satisfactory, as it was both a slight improvement on last year and it was ahead of plan. We also achieved this despite having to make the substantial 256 million euro payment for the enforced guarantee under the Indian contract. This payment was not in our plan and is clearly material, but it has been mitigated so far by good dividend inflow from JVs and also from operating cash flows. The receipt of the Avio sales proceeds helped to reduce group net debt to 4.8 billion euros. The group has also maintained a strong liquidity position. Last month in July, we signed the renewal of the revolving credit facility at the same cost compared to the previous one. This credit line was undrawn at December last year and June this year. The group has no short-term refinancing needs until the end of 2017. Let's move into the guidance. We gave our 2014 guidance to you in March at the full year results. The key points I want to make to you today are: we have broadly achieved our plan in the first half and we are on track. We are positive about the full year guidance and we are confirming the guidance for orders, revenues and EBITDA. We are achieving a strong commercial performance in terms of order intakes. Almost all our operating business are on track. The specific issue in DRS, I want to be clear, had an impact on the first half, but we expect to make up and mitigate this so the aerospace and defense achieve its guidance and we will achieve the guidance at the group level. When we gave to you the 2014 guidance in March, we did say it did assume no further negative impact from the Indian helicopter contract. Unfortunately, the payment was enforced, and so prudently we should adjust the guidance for free operating cash flow and net debt. Therefore, the full year 2014, the group now expects to deliver negative free operating cash flow between 250 and 350 million euros. Thank you.
Okay, thank you. There was probably a mistake. We jumped the transportation slide. I don't want people have strange consequences from that, so we will probably go back to
I think we go
slide.
back a bit. Yes.
Okay, so back on transport.
Yes.
Yeah.
Oh, here we are. Let's talk about transport.
Strange. Transport is impossible.
It was.
To jump.
Absolutely. Okay. You know, first of all, Ansaldo STS is a public company, and you already have seen the results of that. And in summary, strong order and good profitability. About Ansaldo Breda, the key points here are an improved performance compared to last year. Is in line with the plan. And we say that we would work hard to reduce the losses, and we have done so. Now, the new order showed a significant increase with the major metro contract in Peru. Revenue was also higher due to the higher production on metro projects and high-speed and regional trains. So we reduced the losses towards 2013 due to improved program execution and much lower cost overruns. That's about transportation. So we now completed.
Okay, thank you, Giampiero. And we can now move to your questions, and I kindly